Okay, where are we? Where are we? We have, that's what I couldn't hear at the start of the webinar. The wrong thing. Hopefully you can all hear me okay. Got the microphone set up. I'm sharing my screen loud and clear. Wait for everyone to get in. What's going on in the markets? Look at the other screen whilst everyone joins. We've got Russell easing back a bit after yesterday's wild bid. Nasdaq creeping up. It's just creaking over multiple days, isn't it? Putting those little tails in, but keeps flooding higher. Same with the SPOO. Dow, yeah, pretty mixed out there. We've had Trump coming out talking about tariffs on China and all this type of stuff, and Mexico are going to get tariffs, and of course that's hit the peso and all that other stuff. Euro's not fared too bad, considering you would have thought that might have been smashed. Obviously didn't mention anything about Europe. I don't think he did. I didn't dig into the news myself. Saw the headline, but tends to be like if he's going to start lobbing tariffs around, is he going to lob on the EU as well? Remains to be seen. Anyway, this webinar is not about current affairs and the economy. There are people out there who are far have a finger on the pulse far better than I for that. I'm a mere trader who uses it to kind of guide decisions as opposed to digging into foreign policy and tariffs and all that type of stuff. I know what moves the market. I know what's good news. I know what's bad news. I know what impact I should have on the markets I trade. And more importantly, I'm interested when we get an unexpected response. We have some good news, market sells off, have some bad news, market rallies, that type of thing. One thing, if anyone watching Bitcoin, it's a bit of a distraction, I have to admit. I'm not a huge crypto guy, but how funny when everyone was bullish, the whole world was bullish, crept right up to that. Was it 99,800, 99,800, and it's rocked right back. That is the market in to a T. Now, would you have wanted to short it there? Probably not. You know, you're just stabbing at it. But it's just so interesting that everyone was saying it's a done deal, 100,000. People probably buying it for an easy layup trade. And the market does what the market does. When everyone is on one side, it tends to do the opposite. Now, is there a trade from that particular idea? Maybe not this time, but it's interesting to see the psychology of participants when it's so one-sided, when there's so much stuff going on. You've got to be very, very careful, especially if you're long on that. Now, will it rock back and pop back up again? Probably. Is that the top? Who knows? But I just think when you've got something that's just everyone thinks it's a done deal, it's not always the case. And it's always, as a trader, it pays to be smart and go, okay, it could happen. How am I going to plan for it? Am I even trading it? Am I going to take the other side? Probably not. Am I going to go with the flow? Probably not. Depends on the position you've got. So just something to think about. Okay, so let's get started, ladies and gents. Today, we're talking about common trader traps to avoid. This is a good one. I like this one. You are going to get a value from it too. If you've been trading for 6 months, 6 years, this is all going to be super valuable for you. And I'll show you why in a moment. Quote here from Linda Rushke. I think is an excellent trader, well worth looking at some of our webinar content. Reading got a couple of books out there. One is very old, Street Smarts, and she's got a latest one, Trading Sardines. I think that's behind me actually, or my other bookshelf over there. Not sure. That's more of a storybook. I've got a little excerpt for you from a book. But first of all, I must, as you know, go through the risk warning, spread bet CFDs. Of course, if you're trading any instrument that has leverage, you've got to be careful, right? It's great on the upside, you're doing well, and your position long, and you've got your leverage up and it's working. Fantastic. But it works the downside too. Of course, you can very, very easily have the rug pulled from under you, have those red candles when you're long. And if you're margined up, if you're using that leverage, maximum leverage, or even some leverage, it hurt pretty quickly. So just understand the game you're getting into. Leverage, I think, is a useful tool if you know how to use it. But obviously, like anything that's really useful, it does have its downside as well. Just be aware of the risks. Make sure you're only trading money you can afford to lose, especially if you're learning. Think about your daily risk, your per trade risk, your weekly risk, your total account risk. A good way of looking at it is, hey, when will I stop trading? I might have X in my account. And if you draw down by X, will you stop and take a pause? That's just good practice, by the way, anyway, regardless of your risk tolerance. Is, hey, this is not working. Do I need to take a step back? We'll look at all this stuff in a moment, but just a reminder, guys, if you're brand new to trading, obviously be very, very mindful of what you're doing, how you're trading. There's a demo account out there for a reason. If you're seasoned to trading, you know the way it works. You know how margin works. You know how to use stops and all that type of stuff. You're a big boy. You're a big girl. So let's play the game. Right. Common trader traps to avoid. First of all, if I may, a little extract. Oh, and I've just lost the page. Can you believe it? If I don't find it within 10 seconds, I won't say it. But I just picked it up then. Ah, typical. No, no, no. I'm sure it was here. I'm sure it was here. Right. Give myself a few seconds. If I don't find it, I am not going to waste time by scanning through this whole book. The sleeve literally came out as I was picking up the book, and it is worth it. Ah, yes, found it. Found it, found it, found it. How typical. Right. Okay. This book, by the way, is called The Playbook, an inside look at how to think like a professional trader. It's from Mike Bellafiore. He is the owner of a prop firm in New York, so a traditional prop firm, an office, an actual office. Um, and this is more about trading stocks, but he did talk about trading SPY, which is S&P 500, of course, Qs. Nevertheless, let me read you a little excerpt from this, if I may. So this is his reply to a trader who was in the office, who was emailing him and saying, "Hey, things I'm struggling. What can I do? Things aren't working out." So here's a reply, a little extract. It said here, you will have bad streaks. It is the life of a trader. Keep doing the work the market requires to improve every day. Keep searching for the patterns that make the most sense to you. Do not be so hard on yourself when you are just a little off. There is a fine line between crushing it and underperforming. You're not selling iPads at an Apple store here. When you're feeling like the trader above, I think he's referring like he's feeling down about stuff, make the game easier. Lower your position size, trade your best setups, trade your best time frames, and just put up a positive number and then repeat the next day. A lack of confidence can infect every future trade. Rebuild it. Soon you will forget you were ever in a trading bad streak. What an excellent piece of advice. I think that's great. I think if you're struggling with trading, if your confidence is battered, it's just going back to basics, just peeling everything back. As Mike says, small tier size, go to the time frames go to the setups the basic plays, the simple stuff. No need to make it complicated. Hey, I'm buying a support through a wick and an uptrend, whatever it might be for you, the layup play or the play that you're comfortable with. Small size, just get some under your belt. I think the human nature dictates that when we struggle or when we have problems or we have a losing streak, we tend to want to get back to where we were very, very quickly. So equity curve was at X. We draw down over the week. We go, I want to be back to X. I felt good at X. And so we have a sense of urgency and we trade perhaps too much size. We overtrade. We take trades that aren't quite setting up because we believe that actually to get back to where I was, I need to trade because trading means I'm going to make profit. If I make profit back to where I was, and that logic is slightly flawed. In actual fact, the best thing to do in drawdown, as Mike says, is, and by the way, this guy's managing traders who are, significant traders, putting up some serious numbers, guys, and there's doing 7, 8 figures a year. So he is coaching some of the best out there, and he has seen some of the best and some of the worst. And so by peeling this tier size back, so for you, whatever spread bet size you trade, CFD size you trade, peeling it right back and just getting the confidence back, even if it's like a microscopic. It's a good thing about trading Pepperstone, right? You can trade a really small amount. It's very, very almost meaningless to you, but it's enough that you can just start to build that confidence back up. Okay, so let's get started. Hopefully everyone can hear and see me. I'm pretty sure you would have shouted about it by now. If you couldn't, I don't know where the Q&A is on this today. Whether you guys can see the chat or not. Yeah, I guess so. There's still people in there. Okay, right. Then reminded, ladies and gents, I do not. I have experience, but I don't have all the answers. I had a couple of decades plus in the markets, but I don't stand here saying I know everything, pretending to know everything. One of those traders, absolutely not. The market took my ego away from me in the early years and said, "Hey, if you can have an ego, you don't belong here. You need to have confidence, but you need to also respect the market and know that you don't know everything, and you don't have to know everything. You just have to be a specialist in your little zone, in your little area, and that's okay." And I'll share with you some ideas and thoughts, observations from other traders today. Specifically, we're going to talk about other traders, not necessarily great traders. Actually, you know what? Maybe they are great, but traders who are what I would call developing, who have kind of gone through the process of actually putting up some green years and how they differ from others who I'm going to kind of share some of the different things that I've seen and I've observed in those. Because I run Traders Mastermind, which I get to see developing traders coming up through the ranks. I get to see the guys who struggle and fall by the wayside, and I get to see the ones who actually come through and are really pleased with their results, having good success, and are very, very happy. And so much potential there. So that's what we're going to be today. Things take time, by the way. If you do implement anything, take everything I say with a pinch of salt. Go and do your own analysis, do your own research and homework, implement a change and stick to it, and then audit the performance after a certain period of time. We'll talk about that in a moment and make course corrections. Okay, I like to say that every week because I think it's so crucial, because a lot of traders make the mistake of, let's not get ahead of ourselves, but they do make the mistake of doing something, it's not working, and then they flip flop to something else. How many times have you got all fired up over the weekend? You've learned something, you've studied something, you've researched something, you've said, right, that's it, that's going right in my trading plan, and you put it in your trading plan on Monday, you break the rule, it doesn't work out, and so you abandon it by Tuesday. No. You think of it like a business where you say, hey, I'm going to implement a shift and a pivot in how I'm going to trade. Is that a risk rule? Is that a setup? Is that a strategy? Is it a time frame? All those permutations we can talk about. But if you're making that shift and adjustment in the way you trade and the way you approach the markets, stick with it for a bit and then audit the performance a little bit further down the line. Okay, so our goal for today, to identify the common developing trader mistakes so that you can be aware of them. Number one, try to avoid them. Listen, we can stand here and say, oh, I made this mistake and I see this person making this mistake and this is how you avoid it. But we're human beings, right? We all think that we can, we learn by doing, right? That fire is hot, ouch. Don't put your hand in that fire, ouch. It takes a while for it to hardwire in our brain. So I'll do my best today to kind of explain and give you some of the hacks. I don't really like using that word, but maybe ways to avoid some of the common mistakes, or at least if you're aware of them. I think that even if you listen to this today, you maybe take some notes, something comes into your mind. Hopefully, when you start to see them in the real world, i.e., in the trenches and you're trading and you're watching the market, you're going up and down, you have a position or not, and you feel yourself making one of these errors, you might just go, you know what? I remember Mark talking about that. What did he say about that? That resonated with me. I need to be careful. So maybe that's what we're about today. And also give you some tactics that I think are effective to deal with these common mistakes. Okay, so let's go right back upstream, because I think we can be blinkered into, the whole content machine out there for trading is psychology, discipline, and sure, right, it's a big issue. It is a big issue, right? A lot of traders struggle with discipline, struggle with the trading psychology aspect, and there are ways and means of getting better out of that, and getting your trading psychology on point, getting your discipline nailed, so that you can feel like you're doing something. However, there are traders out there, and I think I was probably in this in my early years, my early few years, so 2003, 4, 5. I kind of thought it was a discipline issue, but actually, I don't think I had edge. I didn't really have a plan. I didn't really have a strategy. I kept beating myself up for not holding a trade or doing this or doing that. But actually, you can't really be disciplined and maintain the composure if you don't have at least a plan and a strategy. Now, leave edge out for now, because I know that's a bit of it sometimes feels like, I don't really know what my edge is. I'm still trying to work out. And that's okay. But you at least need a plan. You at least need a strategy. And why I say this, and we're not going to go over this type of stuff old ground here now, but the reason why this is so important is, if you, let's just imagine you have a trade, right? You take a trade, you're long, market goes up to a key level, rolls back and stops out. And you say, oh, I really wish I'll close the trade there. I'm disappointed I didn't see that. And, I mismanaged that. So next day, the market rolls up, goes to a level. You say, I'm going to hold this, and it rolls all the way back down again and stops you out. Like, oh, okay, right now I'm going to pivot and adjust. This time it goes up to the key level, you take it out, and it goes on and on and on. And you beat yourself up for not holding a trade. I can't hold trades. But the key here is you haven't had a plan for it. If you went and you said, hey, this is an A to B trade only, I'm taking the trade out at this key level. It's as simple as that. I don't care where it goes from there. This is my hypothesis. This is my risk tolerance. This is my target. This is how I'm going to structure the trade. In, entry, go. It gets to point B, you take the trade off. You have done your job. Now, if over time you find that actually those A to B trades are running further and further and further, then that's when you make those course corrections, the adjustments to your plan, and you say, hey, actually, I'm coming out a little bit quick here. Can I hold trades for another 5 minutes, another 15 minutes, hour, day, whatever time frame you're trading on, or another percentage of ATR if you're looking for a further extension of a move? And so these little adjustments mean that then you stick to the plan, because you can't blame yourself and say, oh, I can't hold trades, I never hold winners, if you don't have a plan to hold the winner. Now, You may have something that you look at when you get there and say, right, I want to see the time of day. I want to see the price action that's got there. I want to see this, this, and this, or three main points normally is what I like to look at. And those 3 points are what you look at to make your decision whether to hold the trade or not. Again, it's planned. So you're taking a lot of the burden of performance away from you, and you can't then blame discipline. Now, obviously, if it says the rules say, hey, if price has got here, you hold it and you don't, then that is a discipline issue. But having clarity in your approach, your strategy, and the way that you'll manage the trade is so, so important, because then you can identify if it is a discipline issue or it's a psychology issue. And the analogy I've got here is like driving a car for an hour, right? Hop in your car, start the engine, drive for an hour, and you're frustrated because you aren't where you want to be. Well, no, you know what? Because you just went anywhere. You didn't follow the route. You didn't follow the plan. The plan was to go up here, turn right at the T junction, over the roundabout, straight over the lights, the on the motorway, 4 junctions, whatever it might be. You didn't follow that. So, of course, you're going to end up anywhere. It's the same with trading. Unless you have a plan of action, then you can't decipher whether it's a strategy issue or a discipline issue. So that's going back upstream to the kind of the core of the root of the problem, potential problem, and then we can kind of go up from there and say, right, fine. And I think that this actually impacts a lot of traders, and maybe it's you. Maybe you say, you know what, I do beat myself up for not doing this, but actually I need to probably be a bit more precise in how I define my entry. I need to be a bit more precise about how I manage the trade after a certain period of time. I need to be a bit more precise about when I run it or whether I do an A to B trade. And so those few things can help you then work on your discipline. Because if you're breaking the rules, then fine. You've got a discipline issue, you can work on that, it can be solved, no problem. But you will round in circles if you're constantly blaming yourself for something which really there's nothing you could do. It's just like, hey, well, I got it wrong. Of course you're going to get it wrong. It's just trading. You have to be sticking to the plan rather than trying to guess if it's going to go somewhere. Okay. So let's set some expectations. And this, sometimes I feel this gets a bad reception, if you like. But this is the real world, guys. We're not here. It's not Instagram. We're not here saying, oh, you go with a small account and, tomorrow it's going to be a massive account. Now, don't get me wrong. Before I kind of push you away with this, there's nothing wrong with having a big goal. There's nothing wrong with being ambitious and saying, that's where I want to take my trading. I would like my account to be at that level. That's fine. And absolutely, you should do that, I believe. You should have that moonshot. You should have that where you're pushing to, why you in the business in the first place, why are you doing this in the first place, why are you risking capital, why are you allocating resources, time, capital to do this. For most people, it's because they want to hit a certain level. They would like that. But being realistic about the time it will take to get there. In every other endeavor, we're realistic. Like, oh, I want to be a barrister. Well, that's going to take you this amount of years. Well, I want to fly commercial jets for, a top airline. Well, you're going to have to do your PPL. You're going to have to do hours. You're going to have to do this. You're going to have to do this. We don't suddenly expect ourselves to be at the top of the game straight away. We understand that it takes time, but we still have that lofty goal. We say, well, what's the goal this month? What's the goal this week? Well, the goal this month is to stick to the plan. Well, the goal this week is to not slip up on trading in chop, whatever it might be. But they all stack up on top of each other to get to eventually that goal that might take a long period of time. So just think about expectations. And, the industry, say Instagram type of stuff, it's all there and says, oh, you can do this and do that. And I'm sure there are some outlier people out there who maybe take a very small account and make it turn it into a large account. But as we'll see in a minute, that comes with its downsides. And if you are doing that and shooting for that, you should know that you have to expect a heavy drawdown. However, before I put everyone off and go, oh God, this is really, really bad, think about this. If you are realistic, performance can stack up pretty quick. I've seen traders, especially in Traders Mastermind, I can think of one especially who has a very modest account and he's been trading for years. And now over time, he has built that account up to a level now where he's, doing really, really well. And that started because he didn't go wild. He didn't start off with a modest account and start swinging in huge size because he knew and recognized that he only had to have a run that was going to, a weak run, if you like, or a losing run was going to really hammer his confidence. It's going to hammer his capital. And so he solved for the first problem, which is, hey, my strategy, my risk tolerance, can I spend the next few months dialing in my strategy, dialing in my drawdown recovery, dialing in my performance, dialing in all this other stuff? And then once I've done that, I solve for the next job, which is how to maximize my capital. Now I have a strategy that's effective. I think many traders try to solve for that latter, which is how can I make as much money as possible, when actually you're probably doing okay. And what I want to say of this is that I see many traders like this where their performance is actually all right. You've got a modest account, good, that's fine. There's no reason to put in have large account size when you're developing. But the absolute P&L, you're looking at it's like $100 here, £100 here, £50 there, £20 here, £300, whatever the number is relative to the account size you've got, and you get disappointed. That's incorrect, because actually, if you look at the performance and you look at the drawdown, you say, actually, that number, the absolute P&L feels low. Oh, God, I've really studied hard this weekend, and all I've got this week is £50 to show, whatever the number might be for you. But that's okay in the beginning, because that's realistic for your account size and your risk tolerance. Now, listen, if you're trading £800,000 account, £900,000 account, fine. You want bigger returns from that. Your absolute P&L should be relative to that for the effort you're putting in. But just ask yourself, if you have got a modest account, then trying to double it every week is going to end in tears. You might get lucky, of course you will, but there's an element of probability that we can't avoid as traders. We all will have runs where we don't do very well. We'll all have times we're not in tune with the market. We'll all have periods of stagnation. And I urge you to go and look at hedge fund managers' equity curves and performance. Now, you might say, well, hedge fund managers, not ours, Mark, they're managing billions. There are funds out there that are managing tens of millions, and they're intraday trading FX, they're trading opening range breakout strategies. You can find these guys and you can see their performance, and they will be stagnating, they will have drawdown, and their job is to grow the account. On some years, they might have 100% year. Other years, they might have a 1% year. This is the way, the nature of the beast. And so if you get so frustrated because your absolute P&L looks low, take a step back and go, well, that's okay, because I've got a modest account size. And that's not the problem I'm solving for at the moment. I'm solving for strategy and risk tolerance. Okay, so talk about emotional control and discipline. So this is a big one, and I think this affects many people. And I think if we go back upstream again and think about the cause of this isn't a whole topic on this, and I've done stuff like this before, and no doubt we'll go into some depth on this topic again. However, before you label the problem, if you like, as emotional control and discipline, just think of those two things I said before. Where are your trading? Why are you labeling it as like, do you have a clear plan? Are you looking at your absolute numbers and saying that's not very much, but actually it's probably okay relative to the account size you've got? And then you go, right, okay, well, actually, I'm not sticking to my rules. I'm not, kind of doing what I should be doing. Okay, in that case, emotional control comes into play. So the reason emotions really play a big part in trading is that we have, as human beings, such a connection with money, number one, and getting that instant feedback in trading can be difficult to deal with in your early years. And let me explain what I mean by this. If you put a trade on, you're like, I've done this trade, researched it, it's my key level, I've done this, I've done that, I've got all my ducks in a row, click, bang, stops you out. You're like, oh, well, I don't get it. But that's the nature of the beast. That's the uncertainty. And that's why, if we go back to the very, very second slide, you need to stick to it for a period of time and then audit the performance there. Otherwise, the fear comes in and you fear being wrong. And this might be a bit of a strange thing, but I think you might find this as well, that very often it's not necessarily the money that you give back or the losses, it's actually the disappointment that you've made a mistake, that you've slipped up, that your emotions got the better of you. That's more likely the thing that impacts you rather than the drawdown, assuming it's not a huge amount, right? So fear creeps into a lot of things. Fear of missing out on the move, fear of missing out on a potential equity curve boost, and that's what it is. And you think about, if you unwrap all of that, the market might be rallying. You go, I want to get on that. Why do I want to get on that? Well, not because I don't want to look good and, I say I'm on the rally. It's because you want to be able to look at the end of the day and go, oh, look, I got on that rally. My equity curve is high. Dangerous. Fear of giving profits back. Classic one. Unrealized P&L is quite high. You see the market going on, you're long, and you think, oh, that feels good because I'm up this amount. And if I give that back, oh, I'm not going to feel so good. There's a study out there which shows that the impact of a loss is more significant than the benefit, if you like, the impact, the positive impact you get from a gain. And what I mean by that is you think of the two sides of the scale, it should be even, right? I get the joy of a gain, I get the negative impact of a loss. They should be even on the scale. One's a negative emotion, one's a positive emotion. They are not. They are massively skewed with the negative impact of a loss, which is why you might be up, let's say, £1,000, right? For you, you don't want to give anything back. You're like, oh, you know what? I just don't want to give it back, and I have a fear giving it back. And you snatch at the profit when actual fact, that trade could have run on for another 5 hour, 10 hour. Whereas if you go on the other side, we don't want to crystallize the loss. We're down, say 1,000. Use that analogy again. Doesn't matter what the number is. The fear of kind of losing more isn't really there, which is weird because you think it should be completely opposite, but it's not. So be careful of that. Fear of getting profits back is a real nemesis for traders intraday or mid-trade, unrealized P&L, and closed P&L. So your equity curve, you're up X, you don't want to take risk, or you feel like you want to take only layup trades, and there's no such thing. You don't want to risk stuff. Got to be careful of that. And the fear of being wrong, just remember that the best of the best of the best are wrong all the time. There's a great interview out on YouTube with Stanley Druckenmiller, one of the best money managers out there. Sure, he's not intraday trading CFDs, right? But he was talking about, oh, I really messed up on Nvidia. I did. You think, well, hang on a second. This guy's managing billions. He's one of the best traders in the world. And he's saying exactly the same things that we do. The difference is he's like, it's fine. I just get better at it. I accept that I'm going to be wrong sometimes. I know what my strengths are. I know what my weaknesses are. It's cool. And so sometimes when you listen to traders who are at the very, very top of the game, listen to the way they talk about stuff, they just talk about stuff like you and I do. They just talk about stuff that's just, hey, this is normal. This is normal. So slowing down your decision-making process can help put things in perspective. So if you're trading on a very, very short time frame, you're scalping or day trading and struggling with emotional control, struggling with discipline, one quick hack is to just go up a time frame. You're trading on a 5, go up to a 15. Trading on a 15, go up to an hourly. Kind of an hourly, go up to a daily, or even 2 notches, just to slow things down. Now, it might not be where you want to end up as a trader, and that's okay, but just slowing down the decision-making process takes the urgency away, takes the pressure off your shoulders of having to be right instantly now. And so the fear is like, okay, I feel fear, I'm going to miss out. Yeah, but you've got 15 minutes to think about this. You've got time, as opposed to people who are on the really low end scalping stuff. I'm going to miss this click, and the impulse has to be there, because if they don't act, they are going to miss it. So just something to consider is slowing down your time frame if that's an issue. Okay, so let me talk about the expectations, your expectations and worst case scenarios here. So I think you know this. If you've been trading for a while, you know this. But deep down, we do. And we have to remind ourselves of that each day, each morning. Okay? Every trade is not going to be a winner. You know it. I know it. Everyone knows it. No matter what people say, it's just not going to be the case. And so we shouldn't be despondent and frustrated if we get a loser, because that's part of the game. It doesn't matter. It's how we are at the end of the week, the month, the quarter, the year that is important. Now, if you're developing, again, reminder, that doesn't necessarily mean a positive P&L. It means, have I learned? What do I need to do to adjust? How do I adapt? Where are my weaknesses? Where are my strengths? I've got a lot of data now in that quarter. Yes, the equity curve isn't where I want it to be. Yes, the P&L is red, but who cares? Just like we talked about how long it takes and expectations, sometimes that's the best way of going through with stuff. It's complete irrelevance looking at your equity curve you're developing. It's completely irrelevant. I know that that's what everyone looks at. And ironically, when you first start out in trading, what are you glued to? Your P&L, your P&L. And what are you talking? P&L, numbers, 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 numbers. I always tell a trader who is not doomed to fail, but on the wrong path, let's say, if they're coming in and they're talking about, I made 10 grand here, I made 5 grand here, I was up 50K here. If they talk in terms of P&L, it doesn't matter its irrelevance, because what's your account size? If your account size is 4.2 million and you're up 50K a week, so what? So what? If your account size is 5, you're up 50K, you swing in too much. So it's just all relevant, right? So just think about your performance in terms of your process rather than your equity curve. If you can uncouple your brain from your equity curve and give yourself the permission to learn and improve before it becomes important, then that's the way to do it. Now, okay, when you're more experienced, of course, you're going to look at your equity curve. You want to look at the last year green and you go, hey, should I expect to do better this year? And you audit yourself every month and go, what was the best play? What did I miss? What was I better? What should I do? What should I adjust? Where do I really want to be? And fine. But that's when you're more experienced. At the beginning, if you're a developing trader and you may be, or maybe you're experienced, you go, okay, I don't have to fear losing. My expectations are I'm going to lose. I'm going to trade poorly. That's okay. I'm trading small. I'm learning. And the idea is that you dip, 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 and then eventually you rocket off, just like a startup, right? Anyone knows about businesses and startups. They lose money, lose money, lose money, lose money. That's why they get investment, their runway, spending money, spending money, spending money, spending money, trying to find product market fit, trying to find product market fit. Oh, try this didn't work, try this didn't work, try this didn't work. Some of them just drop off because they don't have enough money. Others find product market fit, i.e., something that customers want, how to market that to customers, and all of a sudden they take off. And that's the same with a lot of the big companies we see out there that went through that startup phase. They did exactly that. And it's no different to trading in that you have to go through the period where you're learning, you're discovering, does that work for me? Am I short-term trader? Should I trade in gold? Should I trade in crude oil? Should I focus on the indices? Do I want to trade stocks? Do I want to trade short-term, long-term, mean reversion, trending, and momentum? I don't want to trade pair trading. What I want to do, you have to go through all that to find your product market fit, for want of a better word. And then when you start to find it, then you can worry about the capital preservations initially. You can worry about the capital accumulation after that. And you go, right, I've solved for that product market fit, strategy market fit, mindset market fit, if you like. And how now do I start to put that rubber to the road and start to actually turn that into some results? So don't fear losing or poor trading if you're learning. I promise you, it's not to be feared. It's to be embraced. It's data. As long as you are trading in a very, very small size and it's not costing you a huge amount of money to learn, you can choose the tuition fee, by the way. You can stick in a lot of money and the market will take it, or you can stick in a small amount of money and the market will take that too. And you can still learn. You can still kind of put some skin in the game and realize the type of trader you are. And if you think back to any skill that you've developed in your life, right? Have you learned to drive? Have you learned to fly? Have you learned to ride a motorbike? Have you learned to whatever it might be, right? Maybe you've done something, very, very high level in a professional capacity, medical, engineering, anything like this. It takes time, right? And you didn't expect to be good straight away. And so trading should be no different because trading it's one of these things where the barrier to entry is low, right? You click on the account, open an account, fill out a few details, send over a bit of money, even that's relatively low, and you're a trader. Off you go. But actually, to get developed and to get the skill that's going to help you, it's going to serve you for the rest of your life, it takes some time. So expectations, whilst I do believe you have that goal of, hey, I want to go here, I want this, I want that, that's where I'm headed. But at first, I need to have this stepping stone. I need to have this stepping stone, this stepping stone, and breaking it up like that and giving the credibility to trading that it needs. Because if you look at some of the highest performers out there, they took ages to get there. Right, there's occasions, and I've seen traders myself, they take years to get to a certain point. Sure, some people fast track it, fine. There's people out there who maybe get the right thing, the right time, and gone the right process, and great. But it's just the expectation saying, hey, it's fine. It's fine. It's going to take me some time. And how are we going back to the initial point of fear, right? Fear and discipline. If you're okay and we expect ourselves to be wrong because the best in the world are wrong, so why would we not be wrong? We're going to be wrong. It's going to happen, right? Expect to make mistakes and don't fear them because what's the worst that can happen if you're managing your risk? You lose your capital times your position size, your stop loss, right? Okay, very rarely, now and then, appreciate time for time, you get breaking news, you can get gaps, you can get things that can go in your favor or against you, right? That's the nature of trading. Now, if you're trading a retail account, there are some protections, of course, but you get the idea. There is risk in the markets, but sometimes pragmatically thinking, what's the worst that can happen? Here's my stop, here's my entry, here's my position size. I'm probably going to lose this trade, and that's okay. So what? Why am I fearing pulling the trigger? Why am I worried about it? I'm happy with the risk capital allocated. Yes, fine. That's okay. Now, next trader might win. Next trader might win. If we put too much hope on one trade, then that's when we become disappointed. We go, this one's going to be a winner. This one's going to be a great trade. Oh, stopped out. And that just degrade and remove some of that confidence and remove some of that desire and momentum that's going to get you to that loftier goal that you've got. And so you have to kind of decouple yourself from these short-term results and say, I'm running a batch of trades. There's a guy in our premium community, Scottish John, we call him. He does a batch of 10 trades each time. He's been trading for multiple years. He's green now. I put out a poll actually to see who was green this year, coming up to the end of the year, and he's been green multiple years. But one of the things that he does, which is a great hack, is he just does a batch of 10 trades. He's a batch of 10 trades. He's got a rough idea of his risk on each trade. He doesn't look at the performance, doesn't look at the P&L. He just does his 10 trades and he reviews. He does his 10 trades and he reviews. Others do a batch of 40. So on traders out there who do a 40 trade thing as a learning process. And I think sometimes batching trades in chunks like this can help. You know roughly worst case scenario what you're going to lose based on your risk allocation per trade. And after that 10 trades, you can then audit and say, hey, do I need to make adjustments? Am I chasing the market? Am I buying into falling, trying to catch a falling knife? Am I getting involved in chop? Am I taking too many bites of the same cherry? Those common problems that many traders get, you can identify them and then you go again with the next. And then you go again with the next. And then you don't operate from a place of fear for each trade you take because you say it doesn't matter. It's one of 10 or one of 40. Take the trade, take the damn trade. It's a setup I want. It's a setup I'm comfortable with. It matches my criteria. My risk tolerance is okay. Here's my position size. Click the button. What will be, will be. It's just one of a number. And that's how you grow and improve as a trader when you look at stuff rather than individually. You don't let one trade get the better of you. You don't let one trade define your equity curve for the week and or the month or whatever it might be. So you always use a stop and you always manage your position size, of course. But it's chunking the trade frequency up and then reviewing that actually I think is a bit of a hack. Okay, so next thing, impatience. This is such a brutal one for traders. We are super impatient. Why is Amazon worth 2 trillion? Because when I order something, I want it now. Right, I'm not on one Amazon. I'm like, oh, I need that. It's going to come tomorrow by 10 o'clock. Why can't it come? And then sometimes you get it, it comes the same day. You're like, it's more like it. And then you become accustomed to that. You want something there the same day. You order it, you want it the same day. At least it's going to come tomorrow. My goodness, if you go on an e-commerce site and it says 2 to 3 days, you're like, oh my God, where's this coming from Mars? We are impatient. That's why Amazon is worth 2 trillion, because it's solved the problem of getting any goods you want into your hands within 24 hours or day, worst case scenario, depending on where you live, of course. We're impatient. Human beings are super impatient. Delivery companies, all this type of stuff, they thrive on the fact that we are impatient. And so as traders, we have got to be very, very careful, right? We've got to be very, very careful, and this is no wonder this is the separator, boys and girls. Like if you are going to be impatient in your trading, you are going to just follow the masses down the path of struggling. At some point, you are going to have to veer back onto the patient path, as hard as it may be. And it sounds easy, but I speak from experience that I struggle with lack of patience so much. I struggled with it so much. I wanted it now. I wanted the performance to be quicker. I wanted my trade to work quicker. Now, I'm putting the effort in, push, shove. I want it now. And that's normal, right? Especially if you are ambitious and you're driven and you're focused, you want it quicker. But we must cultivate patience both in the trade level. I'm in the trade, let it run. It's going to take time to go from A to B, even if it is going to go there. It's not going to go there straight away. If it does, great, I'll take it. Otherwise, I might have to sit through a bit of chop. It might have to rotate a few times before it gets there. And that comes in with experience. Then you say, well, actually, that's quite a large target. I do expect a few rotations. I'm expecting a few hours for that trade to mature, and you can become a bit more patient based on logic and experience. When you're a newer trader, you don't know how long it's going to take there, but you can still calibrate your brain and go, is it going to get in the first 5 minutes? Probably not. It's a 200 pip target. That might take a few days, or it might take 15 minutes, or whatever time frame you're trading on. So cultivating patience in our individual trades, and more importantly, in our growth as a trader. This is the biggest killer. This is the biggest trap, bar none, is the impatience that's not happening quick enough. And there are traders out there. Every trader goes through the same thing, should I say. Every single trader sits there and goes, this is not happening quick enough. I am putting the work in, but I'm not seeing the results. Why not? I want it now. It should be now. I deserve it now. We all have that talk. We all have that. But the difference is with the people who are still in the game multiple years down the line, who are putting up green year, are the ones that said, okay, fine. I do want it now, but I'm going to stick to my rules. I'm going to stick to the process. This is a great quote from, I sent this out in a daily email. I send an email out every day to traders. You can sign up for it if you like, tradersmastermind.com. But I send this out every morning. And one of the emails that I sent was a quote from Tim Ferriss. So Tim Ferriss had a letter from his coach. And this is kind of really hit me actually, and some not hit me, but really just perfectly packaged. Dealing with the temporary frustration of not making progress is an integral path towards excellence. And he goes on to say other stuff. And he says this, in fact, this impatience in dealing with frustration is the primary reason most people fail to achieve their goals. Wow, just wow, wow, wow. For trading, this is just big tick. This is perfect. I see traders doing this all the time. They're frustrated, they're not making progress. But the ones who do push through are the ones who accept they're not making progress, accept they're frustrated, but deal with it and go, you know what? It is what it is. I would like it quicker, but it's not happening quicker. So what? And the same with dealing with the impatience of it's one of the reasons why people give up. And normally what happens is this: the equity curve is falling, I'm frustrated, I feel like I'm doing all the right things. I'm going on webinars, I'm reading books, I'm doing research, I'm doing this, I've got a strategy, and it's not working, Oh, you know what? I'm just going to increase my size. They'll fix it. Or I'll just check a few more trades, or just go down the time frames. A big shift, big U-turn, like knee jerk action. And what tends to happen is then the equity curve was falling. That's okay because you were learning, and hopefully you were learning, and that was where the growth was coming, not the equity curve. It was coming in the learning and the experience and the screen time and the experience. All that type of stuff was then going into your subconscious. But the frustration at seeing that equity curve dip, or even stagnate. You made a big lurch to one side. You yanked the steering wheel. Said, I'm going to do some bigger size. I'm going to do this. Equity curve down. You end up giving back a huge amount of profit, or a huge amount of your account balance, should I say. And then, of course, your confidence is in the dumps. You're like, hey, I've been losing for ages. This is the final nail in the coffin. I'm done. So, but it's that impatience and the frustration that we all have through the developing trader process that has to be overcome. And the separator is the trader who can say, I am frustrated. Of course I am. I feel like I'm putting loads of effort and I'm getting nothing out of it. But actually, then you rewire it and reframe it and say, well, I'm learning X. I'm learning this. I'm having this screen time, and every hour I put in front of the screen, or every trade I take, every journal review I do, that's all just one extra rep, one extra rep, one extra rep, one extra rep. And yes, the number that matters is the equity curve, but actually that will come with time. And I need to accept the fact that the majority of people are impatient with that frustration and will fail to achieve their goal. And so the separator has to be by default the man or woman who can deal with the frustration, who can deal with the lack of progress and still move forward. Let me share with you a story of two traders, two real traders out there. Trader one, his name was Nick. His name was actually Nick. He had a good strategy. And I remember speaking to him many years ago, and he said, Mark, you're into trading, can you help me out with the strategy? And I said, listen, and this is someone who didn't come through the normal channels, like, hey, they didn't come through a website, didn't see one of these and coming through there as a friend of a friend, heard about me, knew I'd been trading, knew who I was, said, hey, can you share a strategy? I said, yeah, fine. So I tell you what, open an account, get a demo account first, just get used to stuff. And obviously all the risk disclaimers, and I never advise him and recommend to do anything. Say all the usual things. You've got to already trade with money you can afford to lose, blah, 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 blah. You're a big boy, play the game, understand the rules. Anyway, go through all that, does his demo account, gets used to it, all that other stuff. And then he says, okay, I've put in an X amount of money into my account. And it's a very modest amount, it's a couple of £1,000 or something. His choice, his allocation. I said, okay, try this, Nick. Try. It was a variation of an opening range breakout strategy. I said, here's some basic rules. Obviously, this is no holy grail. This is something that's very simple to follow. The rules are very clear. And what it does is you have the time to be able to sit there and watch that opening range. You have the time to be able to log it, learn, and it would be a good way of get going, because actually, I always say to newer traders, just get some screen time, learn, observe, very, very little capital at risk, expect to lose, don't be despondent, but you must have some kind of strategy you're trying to develop. He said, okay, Mark, okay. So anyway, caught up with him a couple of weeks later, said, how you getting on with the ORB, the opening range breakout? I said, brilliant, man, I'm up by like £120 or something. I was like, excellent. And that was pretty good relative to how much he was trading, what his risk was. He said, I'm just executing. I'm waiting what you said. I'm doing this. I'm doing that. He said, I've made a little change for this. I was like, good, because that's the way to develop a strategy. You take the core of a strategy has got some efficacy. Not always strategies don't always work, but hey, the fundamentals and foundations of it work. You make some tweaks and adjustments based on your observations, and you track it. So this trader was going on and on, and I met him again a couple of weeks, and he was like, "Yeah, it's doing really well. I mean, my account's up really nicely. I had a little bit of a rough day here and there." And then a couple of weeks later, and a month goes by, and every time I see him, he's like, "Yeah, what's going well. I struggled a bit this week, and I lost a little bit, but actually I made a little bit back, and I saw him again, and it's like, oh, it's stagnating." I thought, okay, this would be interesting to see. Anyway, didn't hear from him for ages. Caught up with him. I said, "How's the trading going?" He said, "Oh, mate," he said, "lost it all." I said, "What?" "Yeah, I lost it all." "How? How could you have possibly lost it all?" Because, thinking about the amount of times you trade and this, he said, "Well, I got frustrated with the way things were going, and I kind of did really well in the beginning. I was learning, and I wasn't making any money. So I decided to uh, 10x my position size." So he put in more money in his account and he decided to 10x his position size. And you know what happened, don't you? Of course, you know what happened. The frustration, the lack of results, and he was looking at the wrong metric, the P&L, stagnating or even going slightly lower. And he's going, "Oh, I'd made all this money. Now I was giving it back." And then he said, "Well, how do I get back to there?" "Well, you know what? I'll just do more size." 2 or 3 trades later, the whole profit's wiped out and he'd lost kind of all of his initial stake. And he quit trading. Right? That's an extreme example or a new example, but that is a real highlight of how traders can get frustrated. And even if you've been in the markets for a few years, that still frustration is still there because you say, "I've been in this for a few years. I've been trading for 1, 2, 3, 4, 5 years plus. I still don't think I have the results I should have." But you've got to bear that. You've got to be, okay with that. Trader two, Trader two has a great strategy, right? He has, it's a very simple strategy. He looks for a certain kind of breakout type trade under certain conditions. He scales into his trades. He doesn't trade every day at all. He might have 2 trades a week, if that. Very specific about his time, the way he trades, the way he enters, his adding. It's a very, very clear system for him. He's very methodical with it. And he went through a period of time where nothing was working for him, right? He was just chopping around. He was like, "I've been at this for many years. I don't know where I am with it. I feel completely lost, and I'm just frustrated." And I said to him, "Mate, just get your process and stick to the process. Learn, iterate, improve, adjust, adapt. What's going to need adjusting? How do you make adjustments? And then make fewer and fewer adjustments as things start working." And he's frustrated. Of course he was. He was just like the first guy. But ultimately, he found out that this is working okay. He found a strategy that worked for him. It was clear, it was concise, and here we are. He's rolling on. Things are working fantastically for him. And this is, just same type of person. No one's more intellectual than the others. Maybe the same type of capital, but one just happy to sit there with the frustration and go through the process. The other wanted it now, immediately, and that was the separator. In that instance there with those 2 traders, that was the one key thing. I want it now, I want it quick. He acted on that and he traded more size, he put more capital in, he started risking more when he really did have no business doing that. And the other trader went steady, steady as she goes, small, small, small. And this trader, this trader I'm thinking of as well, he increased his position size massively, massively. Went from very, very small. He had the capital, but he's like, "I'm not deploying it at all." When he got the performance results, he then started more size. Next month, more size, until he's now trading a significant size because he's comfortable with it. He's confident with it. He understands where the drawdown comes from. He's recovered from drawdown before. He knows where the dangers of his system are. And it's just a different result, a completely different result. And he looks at it pragmatically and goes, "That would be my worst case scenario this week if I lost based on my system and my new size. Am I comfortable with that? Yeah. Okay, fine." And so now he's at, really quite decent size. And so the difference of why I illustrate this is, the frustration is so relevant for every single trader, but dealing with it and moving forward is the separator. Okay, so let's talk about solving the wrong problem. Um, this is another thing I see with a lot of traders. If you've got a modest account, which if you're a developing trader, absolutely you should have, There's no reason to have a large account, like I say with that trader there who starts off small. And if you're looking for big gains, you will suffer large drawdowns. You might get away with it once. So what I'm saying is, say you wanted a £2,000 account, you want to turn it 25, 25 want to turn it 250, right? It's possible, it's doable. People have done it, of course, but you can't have a free lunch. If you're going to take that risk, if you're going to scale in aggressively, if you're going to trade the most volatile instruments in the biggest size possible that you're allowed, and you're looking for big gains, expect the probability to catch up with you at some point. And so this is the issue I think many traders have is, of course, they should start with a modest account. Most people do. Most people are smart enough to go, I'm not going to put my life savings in. I'm going to adhere or adhered, should I say, the risk warnings that say only trade with money and prepared to lose. Good. You should do. Absolutely. But then they fall into the trap of, oh, I've got a modest account, but it's not growing. The absolute number is low. Oh, I'm frustrated. But actually, no, because the problem isn't the gains, the absolute gains. If you've got a £5,000 account and you've made £50 on that trade, that's bloody good. If you could do that again and again and again, and you lose a little bit and again and again and again, maybe you make £1,000 that year or £1,500. The numbers are irrelevant, but the percentage gains, the order of magnitude is. You might look at it and go, well, I've worked a whole year. I've only made that much. Yeah, but if you had a modest account, well, you're not expecting to suddenly 10x it. Later down the line, you have to make a decision. And this is maybe for a separate webinar. We say, actually, I've got my progress. This is going to take a long period of time. How do I ramp up my capital? Do I allocate more capital from my own funds? A decision you make as a commercial decision. Do I look at other routes to trade more capital? That's a decision to make and another problem to solve. And so, if you're a modest account looking for big gains, or even a big account looking for big gains, doesn't matter what it is, you're going to suffer large drawdowns. But as long as you're comfortable with that, well, most traders aren't. Most traders are looking to really boost up an account, a modest account, but they aren't prepared to sit through the horrible drawdowns that are probably going to come. Even if you're the best trader in the world, you have a really high win rate, you have a good risk-reward ratio per trade, the probabilities will catch up with you at some point. You will have a string of losers. Those string of losers are going to be horrendous to your equity curve. You're going to look at that. You're not going to be happy. That's going to create all sorts of lack of confidence, all sorts of despondence, frustration, etc. And so just know that if you're trying to do that, then unless you are super lucky, you catch a good run, you hit something right, blah, 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 then the law of large numbers means you will suffer a large drawdown if you're trying to size up. However, if you say to yourself, you know what, I'm going to become the best trader I can be. I'm going to get a strategy that's perfect for me. I'm going to get my mindset on point. I'm going to get emotional control, my risk management dialed in. I'm going to become the best goddamn trader I can be this year. And yes, I've got a modest account, but I don't care because I'm just going to solve for these challenges. I don't care what the absolute number is. I don't care that I could look at it at the end of the year and go, oh my God, there's hardly any money there. I'm going to solve for the things that are important first. Just like a pilot who's flying a little two-seater Cessna, he's not saying, oh, I didn't fly the 747 or the massive, Airbus A380. Oh, I'm failing. No. You're learning the craft first, and then the risk can increase later if you're comfortable with it. If you're comfortable after you put a couple of years in or a year in, whatever it might be for you, is your risk tolerance, your money, and you say, actually, you know what? I'm prepared to risk a little bit more. I'm prepared to kind of now try and solve the problem of having a large absolute gain because I proved my worth. I've built my confidence. I've earned the right to trade more size. And so there's different options I can go to cover that. So you know that you might be solving for the wrong problem. What I mean is your strategy might be effective. You might actually have something there that's meaningful and impactful and is going to work for you, but you're leveraged too much and you're suffering these big swings, which is frustrating you. It's amplifying the emotions. It's amplifying the discipline challenges, all that type of stuff. So sometimes just scaling things down, being realistic about what you're trying to achieve in year 1 or 2 or 3, whatever it might be, based on the account size, and understanding that's a stepping stone to the next, to the next, to the next, is going to serve you much better than going, I'm not where I want to be. I want this absolute number. I want to see these big numbers on the board, but you've got a modest account. So just understand that that's the nature of the beast. And the trader, going back to that guy, who started off small. He was happy with that. He learned his craft. He drew down. He stagnated. He started to make some money. And then he sold for it and said, hey, I want to make X now. I've proven I can do this. Let me increase my size. I have funds I'm happy to risk. Put those in. And he traded accordingly. So something to consider. Make sure you're solving for the correct problem, which is your strategy, your mindset, emotional control, risk management first. Later on, worry about the absolute numbers. So many traders are so focused on that number, the P&L, the P&L, the P&L, the P&L. And honestly, the majority of traders shouldn't even be looking at that. Shouldn't even be looking at that. Sure, later on down the line, it's the metric that matters. Why we're all in the business. But in the beginning, it's not the metric to be looking at. It's not the metric to be focused on. Okay, so moving on here, why can't you stick to your plan? So this is worth mentioning, because people say, I've got a plan, but I'm not sticking to this. So it's usually one of these several things. These are common traps. This is the common traps webinar. I think this is a common trap. The other one we talked about just a moment ago is you're not solving for the right problem, trading too much size, and trying to trade for P&L as opposed to strategy, mindset, all the other stuff. So maybe you've got a plan. Why can't you stick to it? Going back to some of the slides before to kind of collect some of these together and firm it up in our minds, frustration at progress. And what you tend to find is you're going down a path which actually is working, and a few little tweaks and adjustments on the way would make it effective. But actually, you see something else and you go, that would make it quicker. I want speed, just like Amazon. I want it now. I want speed. I want results now. I want performance now. I want my equity curve to be here now, right now. That looks like that's going to get there quicker. You toddle off over there. You try this strategy. Damn, that's not working. You toddle off over here. You try this strategy. You never really make progress because you make a little bit of progress along 5 or 6 levels as opposed to focusing all of your energy and effort on one and building that bridge from one side to the other. If you think of an analogy, right? You've got cliff, and your objective is to build the bridge over here. Lots of people build little bridges. They learn a little bit about scalping, a little bit about trading gold, a little bit about mean reversion, a little about trend trading. Never get anywhere. The trader who makes it across the other side being, performance they want, is they focus their energy and go, I am frustrated. This bridge building is taking a lot of time, and I can see others building it maybe quicker or believed to be quicker. But actually, I'm going to stick at this because if I know, and one more brick, I will get there. And so saying something else is going to be quicker, again, it's back to that frustration point. Allowing emotions to dictate trades. Listen, we all think we know better in the heat of the moment. We learn over time, just like putting a hand in the fire. We learn. We know that actually we don't know better in the heat of the moment. Most of the time, the cool, calm, relaxed planning is going to serve us. So just be careful of that. You don't trust the plan. That's a reason for not sticking to it. But honestly, you've got to start somewhere. And I always say to traders who are developing, just start somewhere and gather data. Just stick to a plan and say, hey, I stuck to the plan. The plan didn't work. That doesn't matter. What was good about it? What was bad about it? Most strategies are effective under certain conditions, and most strategies can work with a few adjustments. But what many traders do is they flip-flop around. They sometimes do this, they sometimes buy the break, they sometimes buy the pullback, sometimes doing this, and they don't really have a plan. And so they're kind of shooting from the hip. You don't have any data, then you have nothing. You've not only got a poor equity curve and frustration, your confidence is battered, but you don't have data to look at because you're like, well, I kind of didn't really stick to anything there. I kind of sometimes took it there when I felt like it. I rolled in a sort of sense of urgency there. I followed this, I chased that. So sort that out. And the final thing is your plan has too many holes. And this is right back to the beginning, so I don't need to repeat this, but you want to take away the pressure of decision making, especially in your formative years as a trader. If this, then that. Later on down the line, you add a bit more discretion, but you don't want to add that pressure of like, geez, should I be buying this? I said I wanted to go long, but I also said I wanted to check this and let me check the price of gold. Let me check the news. Well, what's Bitcoin doing? Oh, what's the 10 hour doing? What's the one? No. You get yourself in a right mess there, and you've got anxieties. No need to do it. Have a plan that's very, very structured. Take away all that pressure of decision making so that you don't have the burden of having to perform. You're like, hey, I'm just sticking to the plan. Now, later on down the line, you add a bit of discretion because you have judgment, you have experience, and you have the ability to adapt and adjust to conditions that are changing intraday or whatever time frame you're trading on. Fine. But in the early days, there's no need to do that because it's very, very difficult to A, get some data, and B, do the right thing and accept the fact that you won't do the right thing most of the time. One more other thing here, taking a long view. So Money traders want it quickly, just like Amazon analogy. That it's a $2 trillion company for a reason. We want it now, and it's the same with trading. But just consider where you are now and where you want to be. Right? Do you think you'll get to that stage to build that bridge over without a loss, without mistake? Of course you won't. Of course you won't. And like I say, if you need proof of that, just go listen to some of the market wizards guys. Go and listen to interviews with Stanley Druckenmiller, Paul Tudor Jones, any of these top traders. They will share their mistakes freely. They're like, I'm the worst at this. And then you kind of chuckle. You're not the worst at this. You're actually one of the best traders in the world. But they're going, oh yeah, I'm the worst at selling too soon. And wait. Did they really hear that? The best hedge fund manager in the world says he's the worst at selling too soon. You're like, what the? That's just the way it is. So it's okay. So don't audit your performance too quickly. Give yourself time to gather data, assess what happened, right? Look, what's happened. At this point, don't look at one trade, two trades, 1 week. Give yourself a month and then look at it. Be solution focused. The second point. Okay, I'm closing my trades too soon. What do I do? If you're solution focused and try and come up with a way of solving the problem that is stopping you from getting to the next level, that's much better than saying, I just can't hold trades. I'm just not sticking to my rules. Well, yeah, okay. So is everybody else gone through this. The difference in the separator is saying, what can I do to fix this? What is going to solve this? These are my three ideas. This. What am I going to implement for the next week? This, implement it, audit. Didn't work. This, audit. That worked. A little tweak, a little adjustment. Problem solved. Next. That's the way to move forward. And using P&L as a metric, as I say, is the worst thing I think that a newer trader can do. One of the biggest traps. It will take what it takes, process focused versus I need to make more money. Make sure you are the trader on the left. It takes what it takes. And the one trade I see this is one trade I think in my mind here who's been in Traders Mastermind for 4 years now. And he said it on one of the calls, like, take what it takes. And I thought, mate, you've got it. You've got it. And there's other traders who I've seen come on and go, like, oh, I made this, I made that, I lost this, I lost that. They don't last long because they're focused on the money side of it versus the guy says it takes what it takes. And he's been planting the seeds, he's been watering the soil. 4 years down the line, things are starting to work. And it's a relaxed way to trade versus focusing on the money. And I know that people don't come into the business for this, don't open an account to go, oh, well, I want to have a long slog of chugging along. But you get to learn and love the process. And if you've been trading for a while and things haven't been happening for you, then maybe it's time for a shift in mindset. Maybe it's time for a shift in the way you approach things. Okay, so last couple of slides here, just as the Fed coming out now, I think he is. Tactics, trade small. You're going to pay the tuition regardless. Choose the price. 2, be clear on your plan. It might not be any good at first, but that is okay. Just stick to a plan. Even if it's buy the open, sell the close, buy the open, sell an ATR. Don't keep making tweaks and adjustments. Just analyze at key intervals. One of the biggest challenges, I spoke to a trader earlier this week, actually. He's been trading for a long period of time and he is very tenacious. He is very ambitious. He is very focused. And he said to me, Mark, I keep making adjustments. So to solve that, let's not keep making adjustments. Stick to something for a while. Expect that it's going to have ebbs and flows. And then you make a commercial decision at the end of the quarter or the month and go, I thought about adjusting that. Should I adjust that or shouldn't I adjust that? And that's the decision. And think of it, I said to him, think like a CEO. Right, you've got all these different stores. Let's say, for example, different stores. One comes in and says, "Oh, you know what? It's not working. That's not working." And someone says, "Oh, we should have headphones now." You're like, "All right, let's sell headphones. Order some." You don't do that. You say, "Okay, let me think about this. Let me analyze the market. Let me make the decision whether that's the right thing for us to move into, because we don't have to allocate resources to that regardless." And just like you, if you adjust your strategy to learn something else, learn something new, do a new time frame or market, you're going to have to allocate resources to that, mental resources. Going to have to get in tune with the market. So it's not a frivolous choice to make. Make a considered decision to make adjustment, a course correction. You know what? I'm going to go up the higher time frames because I've got a quarter worth of data that suggests I'm overtrading, and actually the overtrading is caused by the urgency I see on the 1-minute chart. So I'm going to knock it up a touch. That type of thinking. Number 4, work on the one thing holding you back. I talk about that quite a lot. You can't fix everything. Focus your resources and energy onto one thing at a time. 5, ambitious. Think of where you're going to go. That's cool. That's fine. We need that. We need that pull. We need that to be kind of driving us forward, that they're realistic and say that's not going to happen this week, nor next week, and probably not this year. But that's okay, because the people who have got to the point where I want to get to have taken years to get there and have accepted the fact that it does take that. Have the big goals, but Rome wasn't built in a day. Okay, ladies and gents, let's summarize things, wrap things up now. Common traps to avoid. Don't have a clear defined process. Get that sorted now. There's no excuse for it. Go away, get your defined process. It can be super simple. 2, being impatient with results and getting frustrated. There's no need to be, wind that back. You're going to get frustrated is the correct phrase here. We all get frustrated. We all want it more. You're ambitious. You're driven. I get it. I get it. But we have to learn to be relaxed, patient, and not get frustrated. Realism relative to the capital we've got on account, experience level we've got, look at it and go, I can't expect to have the results yet. That's okay though. Working on too many things at once. I'm trying to become a great mean reversion trader. I'm kind of trying to catch exhaustions. I'm trying to catch trends. I'm trying to trade gold. There's no need. There's more than enough opportunity in one or two markets. As long as you're not trading as some dull market that's doing nothing, there's plenty of opportunity in one or two markets out there. Now, is that where you might end up as a trader at the end of this? Is that where you're going to end up as a trader? Probably not. But just focus your energy on one thing. Think about that bridge analogy. Little bridges, little bridges, little bridges versus the guy who's focusing on one bridge and making constant tweaks and adjustments. Super deadly. It just doesn't serve anybody. Right. That's it. I've overrun a little bit. I hope you don't mind. I like this type of topic. I see a lot of traders falling into traps. I fall into many of these myself. I'm not standing up here saying, oh, I never fall into these. I know what my journey looked like, and I see others have a very similar journey. I see people fall by the wayside. I see people now who, are very happy with their performance and are turning into killers. So that's what I've got for you today. Reminder, if you haven't yet, I know many of you have, if you go to tradersmastermind.com, I have a Google Sheet you can download for free. It's called the Discipline Tracker. You can find it on the website, free of charge. I had this made up. I worked with a developer, Google Sheet developer, kind of. I couldn't do this. Anyway, he's made this so that I can add my daily habits on the side. I can set my goals. And so you can then check off your goals. So if you're trying to improve your performance, you're trying to stick to your plan, you're trying to stick to your checklist, you're trying to stick to a max trades per day, sticking to risk rules, journaling trades, whatever, you can then log off every day that you accomplish this. And then at the end of the month, you go, I did this 8 times. Okay, next month, I'm going to do it 10 times. So it's not being perfect. We can never be perfect straight away, but what we can do is improve the next month. So this was designed exclusively to do this. You get your benchmark, and I did it 5 times this month. I really want to do 20. Well, I'll try and do 10 next month. And the next month, I do 15. And before you know it, 3 months' time, you've solved the problem. Okay, so, there's the Q&A. I've got a couple of, I will spend a few moments for questions, guys. Thank you, Svante. Great webinar. Appreciate that. Jacob says, great webinar again. I appreciate you guys. Thank you so much. Gary says, excellent points as always. Appreciate you, Gary. Oh, a question here. Let me bring you over here. So I don't like I'm just looking at, why can't I do that? I don't know why it won't let me. Anyway, I'm looking at my other screen here. I'm not avoiding the camera. Okay, so thank you, gents. Thank you, ladies and gents. I know you're saying thank you, which is, I appreciate that. I appreciate all of your comments. I do. So this question here, what time frame? Oh, it's quite hard for me to find the right proportionality between higher time frame, trend momentum, and execution time frame. What time frames do you consider significant when scalping on a 1 minute or 5 minute, for example? How far do I zoom out? Is the 1 day a must? Jacob, I always think that the higher time frame is ruling all, right? That now, obviously, do you have to audit it every day? Probably not, but that makes a lot of sense to look at it and say, well, what's happened? Are we stuck in a range? In which case, do you really want to be trading in the middle of that range? Who really cares? That's always my I say in a little bit more blue language than that generally when I'm talking with traders, but who cares about the chart? People should care because our job as short-term traders is to capitalize on supply-demand imbalances, short-term inefficiencies. If nobody cares, higher time frame players, if it's up a bit, down a bit, sitting in a range, then I don't think there's any edge versus a scalper who's, let's say the market's extreme to the downside, it's been stretched. A lot of people care. Longs don't like it. Shorts are in control. You get one more flush. You're scalping then off a key level intraday. There's far more weight to that trade, even though obviously the frequency is not going to be so high. That's okay. You look at the higher time frame, always got to be your North Star. You updated the discipline tracker, Michael says. I did update it. Yes, Michael. It's version, are we on 2.0 now? I think it might be. By the way, any ideas and suggestions, I'm always adding the things to that. Completely free. I want to help you. It's there. You will be added to I will send you a daily email, which you can unsubscribe from if you don't like it. That's fine. I think you will like it. I send an email each day. I think it's thoughtful. I try and make it short and precise. And sometimes I'm guiding you to resources I think are useful, that type of stuff. But there it is. Beth says, thanks very much. Appreciate you, Beth. Jacob says, thanks very much. Some other guys here said, Tony Trade says, where can I get the link to the habit tracker? So discipline tracker, if you go to tradersmastermind.com and on the menu, I'm sure you can find it, discipline tracker will take you to a page. Just enter your email there, Tony, and I'm trying to think what happens now. I think you get it to, I think there is then an email sent to you with a link to that. It's a Google Sheets, and you just click on that link and that copies it to your Google account. You get a copy, then you can do what you want with it. So that link there will copy it to your Google account. There's a template there, and it's pretty self-explanatory how to use it when you see how it gets going, but it will download it to your Google account, then you can do what you want with it. It's yours to use. Benham says, thank you for a great session. That's a great question. How do I will deal with that another time. That's a long question, Benham. How do we disconnect ourselves from money? What is the best way to do that? Oh, yeah. Good question, because decoupling and uncoupling is important. And actually, the earlier you do it, the easier it gets to trade size. Because what you don't want is, as you're going through and you're trying to trade more size, being really attached to it and going, oh, that's quite a lot of money. You want to be early on, decouple yourself. Maybe we'll do a webinar on that at some point. But thank you for the question. And any other questions, I will. A few more here. Hi, Mark. Thank you for the webinar. Lee says, thank you for the webinar. Your emails are informative and motivate me to carry on every day. Thank you, Lee. Appreciate that. I do appreciate that, pal. We've got, 13,000 or so people who read these every morning now. Not everyone reads it, of course, but it delivers to 13,000 people. So I appreciate you, Lee. I'm glad that you find value from that. Okay, ladies and gents, we shall call it an evening there. Happy Thanksgiving to anyone across the pond who is watching this, maybe on YouTube. Take care, ladies and gents. Goodbye for now. Bye.